Look around you. Look at the skyline of your city, the contents of your refrigerator, the balance on your mortgage statement. Every single component of your modern existence is built upon a single, invisible, and silently decaying foundation: the global dominance of the United States dollar. We live in a world where we believe economic stability is a given, a default setting, much like gravity. But what happens when the gravitational pull of the global financial system suddenly weakens? What happens when the foundational bedrock, the very mechanism that has artificially held up your currency, your savings, and your entire standard of living for 5 decades, is quietly and unceremoniously dismantled? The answer is a catastrophic, slow-motion reckoning, and it is happening right now. The history of humanity is, at its core, the history of wealth transfer, power struggles, and survival. Money in all its forms has been and will always be the center of humanity, but that center is shifting. For 50 years, the American empire enjoyed an unprecedented fiscal privilege, a cheat code known as the petrodollar system. It allowed the United States to print money without immediate, devastating consequences, to run staggering deficits, and to export its internal inflation to the rest of the world. That era of impunity has just ended. The expiration of the informal 50-year agreement with Saudi Arabia, a pact established in the shadows of the 1970s, signals not just a diplomatic shift, but terminal diagnosis of the dollar's reign. Most people are oblivious. They are distracted by the noise of politics, the flash of markets, and the persistent hum of normalcy bias. But the definitive observer, the historian peering through the layers of debt and delusion, understands a pattern. When the world's primary customer for energy no longer requires your currency, the game changes. The dollar is next, and understanding its demise is the only path to protecting your own survival. This is not a summary of an impending crisis. This is a factual, geopolitical analysis of an inevitable one. To understand where we are, we must first traverse the ruins of the past. The dollar's global dominance did not begin with the petrodollar. It was born in 1944 at Bretton Woods, where the world tied their currencies to the U.S. dollar, which was in turn tied to gold at $35 an ounce. The dollar was quite literally as good as gold. But empires, driven by the siren song of overextension, always choose war and welfare over fiscal discipline. The demands of Vietnam and surging domestic spending depleted the gold reserves until the promise became a lie. On August 15, 1971, President Richard Nixon unilaterally announced the suspension of the dollar's convertibility to gold, the infamous Nixon shock. The dollar became purely fiat, backed by nothing but the faith and credit of the United States government. This was the first seismic crack in the foundation. American policymakers understood the profound danger of this move. Why would any foreign government continue to hold mountains of mere paper? The solution, brilliantly cynical and devastatingly effective, arrived in 1974. Following the 1973 oil crisis, Secretary of State Henry Kissinger orchestrated a landmark, unwritten arrangement with Saudi Arabia. The pact was simple and revolutionary. Saudi Arabia would agree to price all its oil exports exclusively in U.S. dollars. Any nation, be it Japan, Germany, or Brazil, that needed oil, the lifeblood of the industrial world, first had to acquire U.S. dollars. This artificially manufactured, colossal global demand for the dollar. Furthermore, the Saudis were tasked with petrodollar recycling, reinvesting their massive dollar surpluses back into U.S. Treasury bonds and securities, financing America's rising deficits, and ensuring perpetually low borrowing costs. In return, the United States guaranteed the military protection of the Saudi monarchy. This mechanism was the second foundation of American power, replacing gold with oil. For 50 years, it worked. It meant America could fund 2 wars, send a man to the moon, build an unparalleled military machine, and run a $36 trillion national debt, all while the world silently paid the tab by absorbing our exported inflation. But every temporal agreement has an expiry date, and the fuse has now burned to the end. The unofficial petrodollar agreement, rooted in the 1974 deals, reached its quiet, unacknowledged conclusion. Saudi Arabia, sensing the global shift, has signaled its freedom to accept non-dollar currencies for oil sales. This is the moment the definitive historian watches for. the quiet, almost mundane bureaucratic shift that marks the beginning of the end of an era. The evidence of this tectonic shift is irrefutable. Across the planet, central banks, the very institutions that manage global trust, are quietly diversifying their reserves out of dollars at the fastest pace since World War II. In the late 1990s, the dollar constituted over 70% of global foreign exchange reserves. Today, that share hovers precariously near 57%, favoring a basket of rivals. This is not a mere market fluctuation. It is a structural flight from the dollar. Nations like China and Russia have aggressively reduced their holdings of U.S. treasuries, treating them not as safe assets, but as geopolitical liabilities, especially after sanctions demonstrate America's willingness to weaponize its currency. Simultaneously, the BRICS nations, Brazil, Russia, India, China, South Africa, and its recent powerful additions, are actively building parallel payment systems and settling trade in local currencies like the Chinese yuan and the Indian rupee, bypassing the dollar entirely. This multipolar currency system is chaotic, volatile, and profoundly dangerous for the incumbent power. The great deception of fiat currency is that its collapse always begins abroad, but eventually returns home with a vengeance. For 50 years, the world held the dollar and absorbed the inflationary pressure of America's debt. Now, as foreign governments and trade partners shed trillions of dollars to buy commodities and settle trade in other currencies, those dollars have only one place to go: back to the United States. This is a mechanism of hyperinflation, a rapid contraction of currency value caused by the sudden return of vast excess supply into the domestic economy. It will not be the 6% or 8% inflation we have recently endured. It will be the destructive, runaway inflation that annihilates the middle class. Consider Elias, a man whose invented narrative is a composite of thousands of small business owners facing this reality. Elias runs a machine shop in Cincinnati, specializing in precision parts. For decades, his biggest threat was competition. Now, his threat is purely monetary. 90% of his specialty steel and CNC components are sourced from Asia and Europe. Price and currencies increasingly decoupled from the dollar. When the dollar weakens globally, due to the very loss of its petrodollar demand, the cost of his imported raw materials explodes. Elias's margins vanish overnight. He raises his prices, fueling domestic inflation, but his customers, local manufacturers, cannot keep up. His credit lines, once subsidized by the world's demand for U.S. bonds, suddenly become crushing due to spiking interest rates. Elias is not failing because he is unproductive or inefficient. He is failing because the macroeconomic privilege that sustained the American marketplace has been revoked. He is a victim of a geopolitical currency war fought not with tanks, but with a subtle manipulation of foreign exchange rates. His fear is not a personal failure, but a profound realization that the entire economic superstructure he trusted is designed to extract his wealth when it enters decline. Then there is Sarah, an invented case study of psychological betrayal. Sarah is 78 years old, living off a modest fixed pension, and a 401k she diligently saved over 4 decades. She does not own gold or Bitcoin. She owns what every mainstream financial advisor told her was safe: dollar-denominated treasury bonds and low-risk index funds. Her psychological security is anchored in the belief that the dollar, the global reserve currency, is the ultimate safe asset. But as the foreign flight from U.S. treasuries accelerates, because global buyers no longer need a parking spot for their petrodollars, bond prices fall and interest rates are forced higher. Sarah's portfolio value declines, but far worse is a collapse of her purchasing power. The cost of her medication, her imported specialized medical equipment, and her heating bill, all priced globally, spike uncontrollably. Her fixed income, once enough to live comfortably, is now barely enough for essentials. She is haunted by the fear of destitution, a profound psychological weight borne by generations past who trusted paper money during the collapse of the Roman denarius or the German Papiermark. Her resilience, built through decades of discipline, is undone not by a bad investment choice, but by the systemic failure of government that chose debt over durability. This is the deeply personal psychology of money. The currency's strength determines the price of your survival. The FOMO that drove Elias to borrow for expansion and the fear that kept Sarah invested in safe assets are both being weaponized by the final, desperate acts of a system in collapse. The pain of inflation is not just a statistical anomaly. It is a confiscation of time and effort from the weakest members of the economy. History is brutally clear. Every reserve currency that has chosen the path of overextension, military might over fiscal health, and infinite money printing has met the same fate. The Spanish silver dollar funded an empire but collapsed into inflation when the silver mines ran dry and the debts mounted. The Dutch guilder, dominant in the 17th century, was overtaken when war and financial innovation shifted the center of trade. The British pound sterling, which commanded the world's trade and reserves in the 19th and early 20th centuries, crumbled under the weight of 2 world wars and immense debt to the United States. Its share of global reserves, once nearly 30% in the 1920s, was regionally contained within 2 decades of the war's end. The pattern is undeniable: over-leveraging, currency debasement, loss of confidence, and then the final, rapid collapse. The U.S. dollar, in its 80th year of dominance, is simply next in line. What differentiates this collapse is the absence of a clear successor. The euro is fractured. The Chinese yuan is controlled by an authoritarian state no one truly trusts, and a basket of currencies promises volatility and chaos. We are entering a global currency vacuum, a period of financial and geopolitical fragmentation unlike anything seen since the 1930s. But the future, though chaotic, is not without structure for those who see clearly. The smart money, the definitive financial observer, is already moving. They are escaping the gravity of the dollar. Billionaires and sovereign wealth funds are not speculating. They are repositioning based on historical certainty. They are buying productive, non-fiat assets. Bill Gates' unprecedented acquisition of American farmland is not a venture into agriculture. It is a hedge against currency collapse, a purchase of land that produces food, a necessity that holds value regardless of what kind of paper you use to transact. Ray Dalio, the veteran hedge fund manager, has allocated significant capital to gold and foreign assets, understanding that diversification out of the collapsing incumbent is the first rule of empire decline. Central banks, especially those of the BRICS nations, are stockpiling physical gold at record levels. Over 1,000 tons in a single recent year, a powerful, visible signal that they are losing faith in the paper promises of the West. The actionable conclusion is simple, rooted in the preservation of capital and the fundamental understanding that while paper dies, tangible value survives. Resilience in the coming monetary crisis demands discipline and a rejection of normalcy bias. First, reduce reliance on dollar-denominated debt. While inflation can theoretically inflate debt away, the chaos of transition, the loss of job, the inability to access credit, the frozen banking system, makes high leverage a death trap. Maximum flexibility and minimal debt is the safest financial position. Second, embrace tangibility and productive assets. This means owning real assets that cannot be printed. Physical precious metals, gold and silver, agricultural land, essential infrastructure, or private businesses that provide real-world, localized value. It also means viewing the leading digital asset Bitcoin as a non-sovereign hard cap store of value, a potential global exit ramp from the failures of central banking, a direct challenge to the fiat system. Third, the ultimate hedge is not an investment. It is a resilience of self and community. When systems break, complex supply chains fragment, and the government ability to provide collapses, local networks, the ability to grow food, the possession of portable skills, and trust with neighbors become the truest form of wealth. The petrodollar was not sound economics. It was a temporary geopolitical agreement that granted the United States an unparalleled half-century financial advantage. That advantage is now revoked. The great cycle of empires is playing out with mathematical inevitability. The script that ended the Roman denarius, the Spanish real, and the British pound has been dusted off and is now being read for the U.S. dollar. The question is not whether the dollar's global reign will end. The question, for every individual who has built a life on its promise, is whether you choose to be the oblivious spectator or the informed survivor. Money as it was, is, and will always be the center of humanity. Protect your center. Prepare now. If you came out of this feeling smarter, or maybe just a little more prepared, hit that subscribe button. We'll continue to track the forces shaping tomorrow, from global currencies to your personal budget. Now, click on one of the videos you see on screen. Thanks for watching, and we'll see you next time on BRICOIN by Adam.